How to convert a lease option to a wraparound note. Quick review. What is a lease with option? A lease agreement grants possession of an asset to the lessee while ownership remains with the owner of record. An option contract grants the exclusive, unrestricted, irrevocable right and option to purchase the asset under the specified price and terms for a specified time frame. A lease with option is two distinct, legally binding contracts, a lease agreement and an option contract. The lease with option is not a way to circumvent the Dodd-Frank legislation regarding consumer credit for owner-occupied housing. If offering a lease with option to a lessee who intends to occupy the house as a primary residence, then a licensed residential mortgage loan originator must be involved in the transaction to qualify the lessee and to provide the required disclosures. If the option term exceeds 3 years, then the existing debt lien holder may invoke the due on sale clause. The goals of the lease with option. The first goal of the lease with option is to acquire control of the property to generate a net positive cash flow from managing the operations. The second goal is to improve the performance of the property to increase its capitalized property value. This is created equity. The third goal is to monetize the created equity by exercising or assigning, that is, selling, the option contract. Title to the property remains with the current owners of record until the option contract is exercised. At exercise, the purchase and sale agreement that is attached to the option contract is signed by the then current optionee as the buyer, and then the PSA is completed. The PSA was previously signed and notarized by the owners of record, attached to the option contract, and held in escrow until the option contract concludes, that is, exercised or expired. A memorandum of option is also recorded at the Office of Public Records in the county in which the property is situated, and a release of memorandum is held in escrow to be recorded at option contract conclusion. The different financial structures. The first financial structure is based on the weighted average of two financing tranches that equals the effective capitalization rate, calculated by dividing the net operating income by the capitalized property value, that is, the seller's asking price. This is for income properties. The second financial structure is based on the prevailing market rents and the applied rent credit, that is, additional option consideration, that reduces the balance due at exercise. This is the most common form of lease with option used with owner-occupied residential properties, that is, 1 to 4 dwelling units per tax parcel. The third financial structure is designed according to the existing financing on the property to gain credit for amortizing the existing debt during the lease term. In all of the financial structures, the optionee must know the existing debt structure and have access to those lenders with an authorization to release information signed by all owners of record. Also, there must not be a revolving line of credit because the owners could steal the created equity. All debt tranches must be closed-end and a recorded memorandum of option notarized by the seller clouds the title to prevent further voluntary liens from attaching to the property. The weighted average capital cost. The weighted average capital cost is how multiple financing tranches are blended together to calculate the capitalization rate. Loan to value, equity to value, annual debt constant, capitalization rate, cash on cash return, capitalized property value, net operating income. Equity to value equals 100% minus the loan to value ratio. CAP equals the product of the annual debt constant times the loan to value ratio plus the product of the cash on cash return times the equity to value ratio. This is mathematically equal to the net operating income divided by the capitalized property value. You can use a similar weighted average calculation to calculate the price, that is, the cost and structure of financing for a lease with option structured as 100% seller financing acquisition. There are two tranches that look like debt, with a primary interest-only tranche for the lease payments and a secondary principal-only tranche for the option consideration payments, sometimes called applied rent credits. Lease payments will not change your debt position, so that is exactly like an interest-only loan. The option consideration payments are applied directly to the purchase price to reduce the balance due at exercise, so that is exactly like a principal-only loan. Calculating the secondary principal-only tranche is easy. The interest rate is 0. The amortization term and the maturity, the balloon term, are equal, that is, fully amortizing. The periodic payment is the debt present value divided by the number of amortizing payment periods. Therefore, the secondary periodic debt constant is the reciprocal of the payment periods. The secondary annual debt constant is the secondary periodic debt constant multiplied by the number of payment periods per year. In this example, there are 12 monthly payments per year. SPDC equals 1 divided by PER. SADC equals 12 times SPDC. Calculating the primary interest-only rate is not so straightforward. That calculation requires a weighted average of the combined annual debt constant for the 100% financing structure. The debt coverage ratio method, DCRM, is mathematically identical to the WACC. The debt coverage ratio, DCR, is the ratio of the net operating income divided by the annual debt service. DCR equals NOI divided by ADS. CAP equals DCR times ADC times LTV, mathematically equal to the net operating income divided by the capitalized property value. The combined ADC is the weighted average of the primary annual debt constant, PADC, and the secondary annual debt constant, SADC. The weights are the primary loan-to-value ratio, PLTV, and the secondary loan-to-value ratio, SLTV. The sum of the weights equals 100%. Because there are two debt tranches and no equity tranche. For example, the ratio PLTV to SLTV split may be 90% to 10%, or 80% to 20%, or whatever you can negotiate for a conservative split between the tranches. You choose your desired debt coverage ratio to generate positive net cash flow for you while structuring the 100% seller financing to meet the seller's price. The debt coverage margin, DCM, is the reciprocal of the DCR. DCM equals 1 divided by DCR. LTV equals primary loan-to-value ratio plus secondary loan-to-value ratio equals 100%. Annual debt constant equals the product of the primary annual debt constant times the primary loan-to-value ratio plus the product of the secondary annual debt constant times the secondary loan-to-value ratio. The cap is equal to debt coverage ratio times annual debt constant times loan-to-value equals debt coverage ratio times annual debt constant times 100%. 100% is just the value 1, so that is equal to DCR times ADC, which is equal to DCR times the quantity, the product of primary ADC times primary loan-to-value plus the product of secondary ADC times secondary loan-to-value. We can simplify this to cap rate divided by DCR equals cap rate times DCM equals annual debt constant, which is equal to the sum of the product of PADC times PLTV plus the product of SADC times SLTV. We then subtract the secondary tranche from both sides. We then divide by the primary loan-to-value ratio to isolate the primary annual debt constant. The primary annual interest-only rate equals the calculated primary annual debt constant. The capitalized property value is the agreed purchase price, which fits the cap rate according to the product of the DCR multiplied by the combined annual debt constant. The wraparound note. You can blend together the two seller financing tranches to calculate a wraparound style financing structure that combines the periodic payments of the two debt tranches. The maturity, that is the balloon payment, matches the primary debt present value because the primary debt tranche is interest only, and the secondary debt tranche is fully amortized at maturity. I use a spreadsheet to calculate the effective blended interest rate and the effective amortization periods for the entire wrap note. Thus, for a motivated seller who will accept a 100% lease with option transaction, you can negotiate to replace the lease with option parameters with a 100% seller financing wraparound note that gives the seller the same purchase price, the same payments, and the same future value, that is the balloon payment, as the lease with option parameters, as well as full conveyance of responsibility for the property. You get the same net cash flow after debt service according to your chosen debt coverage ratio. Both sides win. Be sure to structure the lease with options so that your principal paydown is better than the depreciation tax benefits of ownership. Also, be sure that your maturity term is far enough in the future so that you can refinance the property to redeem the maturity, that is the balloon payment, when due. This kind of structured financing works for residential and commercial income properties when the seller is strongly motivated for debt relief or to get his price. It's all about negotiating price versus terms. One side chooses the price and the other side chooses the terms. If one side insists on both price and terms, then there is nothing to negotiate. Take it or leave it. Be willing to walk away when the deal will not produce a conservative net cash flow for you and a back-end profit. Be sure your chosen debt coverage ratio can tolerate recessionary pressure on income and expense to avoid default. Prevailing market rents and applied rent credits. This is how most people design their lease with option for small residential properties such as homes. For example, they determine a fair market rent at, say, $1,000 per month and include an applied rent credit, that is, additional option consideration at, say, $100 per month. The lease with option term is, say, 60 months, that is 5 years. The purchase price before applying rent credits is $100,000. This is the blended debt present value, which is the sum of the primary debt present value plus the secondary debt present value. B DPV equals P DPV plus S DPV. The financing structure is designed as two tranches, again as a primary interest-only tranche for the effective lease payments of $900 per month and a secondary principal-only tranche for the additional option consideration, that is the applied rent credits, of $100 per month. Calculate the SDPV as the monthly rent credit multiplied by the number of months in the lease with option term. In this example, SDPV equals $6,000 equals $100 times 60. That is your secondary debt present value. The secondary annual debt constant, SADC, is calculated the same as described in the previous section as the number of payment periods per year divided by the total payment periods in the lease with option term. Calculate the PDPV as the difference between the blended debt present value minus the secondary debt present value. In this example, PDPV equals BDPV minus SDPV equals $100,000 minus $6,000 equals $94,000. That is the primary debt present value. Calculate the primary annual debt constant, PADC, as the number of annual payment periods multiplied by the primary periodic debt service, then divided by the PDPV. In this example, there are 12 periodic, that is monthly payments per year. PADC equals annual payment periods multiplied by primary periodic debt service divided by primary debt present value equals 12 times $900 divided by $94,000 equals 11.4894%. The primary annual interest-only rate equals the primary annual debt constant. Existing underlying debt. In this situation, the seller has existing debt that is serviced by the lease payments plus some equity that is paid in equal principal-only payments as additional option consideration. Again, the sum of the debt present value of the two tranches for the lease with option equals the purchase price or the remaining unpaid principal balance, the UPB, when an initial option consideration payment is required, similar to a down payment. By the way, if the existing debt on the property has a revolving open-ended debt tranche, for example, a HELOC, home equity line of credit, then that tranche must be closed to prevent the seller from pulling out the equity paid by the buyer, effectively stealing the buyer's invested equity. Recommend refinancing that tranche into a closed-end junior mortgage loan, or refinancing all existing debt tranches into a single first-position mortgage loan with a fixed interest rate. Also, the buyer should include a contract clause that any amortization of the existing debt is credited as additional option consideration at exercise of the option contract. After all, the buyer is paying that debt service and therefore should benefit from the amortization. It's an important negotiation point, but not a deal breaker. You won't get it unless you ask for it. The lease with option term is calculated as the shortest maturity term of the tranches that is not fully amortizing. Thus, the option must be exercised on or before the nearest maturity balloon payment is due to redeem all of the remaining debt tranches. The multiple existing debt tranches are blended by adding the debt present value of each tranche to calculate the blended debt present value. Then the blended periodic debt service, BPDS, is calculated by adding the periodic debt service, for example, the monthly payments, of each tranche. Then the maturity, that is the balloon payments, are calculated separately for each debt tranche according to the calculated lease with option term, and then summed. This is the blended debt future value, BDFV, which is the total maturity balloon payment at exercise. Remember, the secondary option consideration tranche is fully amortized at the end of the term. The interest rate is calculated from the blended debt present value, blended periodic debt service, the term, and the blended debt future value. A spreadsheet or financial calculator can perform this iterative calculation. The amortization periods, NPER, the number of periods, to fully amortize the blended debt is calculated from the blended debt present value, the interest rate, the blended periodic debt service, with a future value of 0. A spreadsheet or financial calculator can perform this calculation. Round the calculated NPER to the nearest whole number. The BDPV, the interest rate, the number of periods to fully amortize, the blended periodic debt service, the maturity term, the blended debt future value, is the primary tranche for the lease with option. This tranche is not interest only because it is designed to service the underlying blended amortizing debt tranches. This is how the buyer, that is you, receives credit for amortizing the existing debt. The secondary debt present value is the difference between the unpaid principal balance minus the blended debt present value. This is the effective equity. You calculate the principal-only secondary periodic debt service, SPDS, as the SDPV divided by the term. SDPV equals UPB minus BDPV. The secondary periodic debt service equals the secondary debt present value divided by the maturity term. At the end of the lease with option term, the secondary debt present value has been fully amortized, and the blended debt present value has been amortized to the blended debt future value, which is the balance due at exercise. This calculation also works when there is no seller equity. Converting the lease with option to a wraparound note. You can use a similar set of calculations described above to blend the entire lease with option structure into a seller financing wraparound note with the same purchase price or unpaid principal balance, the same maturity periods, that is the maturity term, the same periodic payments, the sum of the blended periodic debt service plus the secondary periodic debt service, and the same maturity, the blended debt future value. The wraparound note requires specifying the annual interest rate and the amortization periods, the number of periods to fully amortize, which you can calculate with a spreadsheet from the other parameters. Calculate the rate that will amortize the blended debt present value to the blended debt future value with the blended periodic debt service over the maturity term. Then calculate the number of periods to fully amortize the blended debt present value to 0 for the blended periodic debt service. Round to the nearest whole number. When restructuring the lease with option into the wraparound note, remember to exclude the periodic expenses from the periodic payments because those costs are passed on to the buyer rather than paid by the note holder from the gross payments. You can collect property taxes and insurance premiums, but those expenses must be escrowed and paid by a neutral third party. For example, a bank collections account, a CPA escrow account, or a loan servicing company. If there is underlying debt, then that lender is probably already escrowing for taxes and insurance. Now comes the real power of the wraparound note. After you get agreement in contractual form from the seller for the wraparound transaction, you can assign, that is, sell your contract to a third-party buyer for a combination of a cash assignment fee, must be greater than the initial option consideration to the seller, plus another wraparound note that wraps the seller's wraparound note. Your buyer's purchase price is marked up from the seller's purchase price. You created equity out of thin air by offering easy financing. And you increase the interest rate. Remember, buyers who need seller financing are not interested in the lowest price. They are interested in the easiest financing terms with affordable payments. Wrapping a wraparound note is far superior to a sandwich lease with option. With a wraparound note, the property is conveyed by deed out of the seller's name, which protects the buyer's interest from future liens and judgments against the seller. If the buyer defaults on the lease with option, then an equitable mortgage defense may be raised, forcing the seller into a judicial foreclosure which takes months to complete while the deadbeat tenant lives in the property rent-free. Defaulting a wraparound note is a foreclosure process. That is a fast, non-judicial foreclosure for an all-inclusive trust deed. Or you can get a deed in lieu of foreclosure, that is, offering cash for keys. Also, when the buyer is ready to exercise the option, the seller may invoke legal shenanigans to renege on his obligation, and you are still in the middle of the sandwich, so both parties will include you in the lawsuit. Therefore, stay out of the sandwich, stay out of the title chain of ownership, and just be a lien holder. Your life will be much simpler just walking out to your mailbox each month and collecting a check. You now have a nothing down deal to flip a move-in ready property that generates cash now, plus cash flow over the life of the wraparound note, plus a net maturity that is balloon payment, that is the difference between your buyer's maturity redemption minus the seller's maturity redemption. The seller's wraparound note is amortizing faster than your wraparound note because you marked up the interest rate. You have passive income from your note and none of the risks or headaches of ownership and managing tenants. You are not a landlord. You are an investment banker. Use a neutral third-party loan servicing company, a bank collections account, or a CPA escrow account to receive the payments from the buyer, and then the account provider pays the existing liens in priority order. The note payor pays the nominal service charge. This prevents the seller from skimming the equity, stealing the payments, and letting the underlying debt default. Always retain an experienced real estate attorney to handle the legal paperwork and a licensed mortgage loan originator to provide the disclosures and qualify the buyer. Be creative and think outside of the box. Get more information and an Excel 2016 macro-enabled spreadsheet with 2016 mail merge templates at this URL. My name is Jeffrey Smith, and thank you for your support.